Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking banks. They used to be the darlings of the Australian share market, but in more recent times, with a slew of equity raisings, they've fallen on harder times. Joining me today is Roger Montgomery from the Montgomery Fund and Justin Braitling from Watermark Funds Management. Start with you, Justin. The banks, they've raised a lot of money. They've come back maybe 25, 30% in share price. Do you like to look at them at these prices? And I'm talking about the big four banks.
In terms of capital, APRA have made it clear they want the capital situation to be resolved by 16. So it's largely done now. I think they've raised about $23 billion. And in terms of the other Basel III requirements around liquid assets and stable funding ratios, they've largely been addressed as well. So most of the regulatory impulses are addressed. Short term, I think they have been oversold and there's some value emerging there. Having said that, there's very little growth in these businesses going forward, and they're really struggling to pay their dividends. I just went through ANZ's annual report. They're actually prepaying tax, Matthew, to generate enough franking to pay their dividend, which is quite a change.
Which is interesting. Rog, Justin, they've come back. The yield looks compelling. We all know that the capital has been raised, and that's been a weight. Is it time?
The first thing I'd say is there used to be the big four banks. Now there's the big three, and there's NAB.
Right.
NAB's domestic business is operating at such an inferior level compared to the rest of the banks that I would separate that out. Having said that, I think you could divide out Westpac and the CBA, and ANZ and the NAB. And all of them are suffering on their net interest margins. Really, they're either flat or under pressure. And so I believe that while they do appear cheap, particularly the CBA and Westpac now in the short term, as Justin said, in the longer run, I think there's been a few nails put in the coffin of credit growth. And that's because they've raised rates on investor loans and mortgages, and that's where most of their growth has been coming from, and that's now going to slow.
So, Justin, Roger slipped there into stock selection, and we normally say the big four and we group them together. Do you want to prioritise if the best buy down to the stock that you don't like out of those big four?
As you know, we're a long-short investor, so we're often pairing up positions. And banks are actually quite easy because they're two retail banks, Westpac and CBA. Most of their business is about mortgages. And then they have the business banks, which are NAB and ANZ, so they're much more exposed to the trends in the business environment. And so we are long NAB, short ANZ. We think NAB is doing all the right things, and the turnaround is finally happening. Even the business bank is starting to perform. They're giving up some NIM. We've seen that more recently as they price their SME loans, but they're picking up volume. So, and the other banks confirm that's the right strategy for NAB. ANZ has some real challenges ahead of them, particularly in Asia. We saw the impaired loans or the bad and doubtful debts expense in Asia quadruple in their last result. They have real risks in their business, which we think will present themselves in the next down cycle. The two retail banks, Westpac and CBA, both fine businesses, but we think CBA has the leadership position there over Westpac if we had to choose one.
Okay, Rog, you mentioned how NAB had fallen away from the big four. It was the big three. Of those big three?
Well, it used to be, can I just interrupt you there? We used to believe that the reason for its poorer return on equity was the fact that it had overpaid in the UK. What we're now seeing in the latest results is that we believe that its domestic business is inferior, and so we think that we don't want to own a business that has inferior economics, particularly in an environment where credit growth is slowing. Sorry, what was your question going to be?
So, of the other three, is there a best and a next best?
Well, we own the CBA and Westpac. We don't own the ANZ for the same reasons that Justin mentioned, and I think that's about it. The pullback that we saw in prices brought them back to sort of fair value. They weren't bargains by any stretch, just about fair value.
So on that basis, should we be scared of holding them now?
Well,
if you go back to the start of the year, you would be scared because
the most conservative. If I was going to sit on the fence, I'd say don't expect the sort of returns that you've seen in the past in terms of capital gain. In order to grow from here, they have to grow their credit, they have to grow their lending, and I'm very concerned that any growth that they get out of, let's say, business banking, they're going to more than compensate for that on the downside because of the decline in growth on mortgages. And I really do believe that as a result of their own actions, they've shot themselves in the foot in terms of the property market and where that's going to go.
Okay, Justin, it used to be just concentrate on the yield, and then we found out during the course of this year that you can lose on your capital with the banks. So they've come back, same question as I asked Roger, should you be scared to own them, or are they okay value here and you don't have to worry about your capital overly?
Banks' profits are driven by the balance sheet and not by the income statement. And so banks are far more exposed, they're highly leveraged vehicles that are very exposed to asset market, movements in asset markets and the credit cycle. And so we haven't seen a credit cycle for decades here in Australia, a deep one. Investors buy them for their yield. It's the last thing to focus on. You need to think first and foremost about where you are in the credit cycle, what credit risks you carry in investing in those businesses, and they're significant. And so they are far more risky, these businesses, than people realise. The risk is in the price that you pay, and that risk has diminished because the price is a lot lower today than it was even 6 months ago. And the credit risk they're carrying in their balance sheet, and some carry more than others, and we talked about some of the names there. But we haven't seen a deep credit cycle. We're really at the sweet spot in the cycle now. Impaired loans are at record lows. There's very little stress out there because of very low interest rates. But we would expect some of those impairments and bad and doubtful debts expenses they can only really go one way, which means their profits will be very modest in the medium term. And there'll be a time when their profits will fall quite sharply.
So banks, they have fallen. Are they a good buy here? Some are, some aren't, but still be very careful.